Hello, hello, hello. Welcome, everyone. Thank you for assisting to this panel. We will be talking about an ordinary day in the crypto history, the October 10th. And for some people that might not have experienced it firsthand or might not remember what happened on October 10th, could you guys please give some context about this day and what happened? If needed, I can give you some context as well.
Well, okay, let me start. So what actually happened is, and not going through everything because that's the thing of the panel, we had the tariff announcements, well, back and forth, and then we had pretty strong tariff announcements from Donald Trump, which caused a major market meltdown in TradFi as well as in crypto following that, right? And then everything from there unfolded, and I guess we're going to uncover a little bit what happened, what went good and what went bad, and what we can learn out of this. But especially for crypto, if you look at it, it had a pretty bad impact. Since then, volumes didn't recover, neither in spot nor in derivatives trading, whereas in TradFi, volumes went up, prices went up. Since October 10th, basically the digital asset space or crypto space is in kind of the real bear market mode.
Yeah, I'll just add to that. As well as the TradFi issue around the tariffs, it was a perfect storm at that time as well. There was quite a few things that were happening where, unfortunately, they all happened close to the same time. The tariffs announcement was a key one that caused the meltdown across all the markets, and that obviously impacted crypto. The other one, which is very rarely talked about, but it potentially had some impact, was the Morgan Stanley index announcement around the exclusion of DATs from indices, and they should be treated as funds. That had a potential impact that wasn't easy to quantify, and I'm positive in some of the analysis that we've done internally that caused some issues as well. And then obviously the leverage and all the other, let's just say the normal things that go on in crypto, it was a perfect storm what happened in 1010. So we'll talk a bit about that and a lot of the details of everything coming together and the cascading impact of that.
Yeah, and I'm really glad you brought the memo up because it was released 2 days before. And before even 1010, we started seeing some downward price action on Bitcoin. And so essentially what happened is Bitcoin lost 15% in a matter of minutes. It amounted to over 20 billion in liquidation, which was the highest amount ever recorded. Also, this number might not be correct. It might be up to 50 billion because we do not have access to all the numbers. But essentially, anywhere you were trading with leverage, you got impacted in some way. I actually experienced 1010 firsthand, but I didn't experience it as a leverage trader. I had a loan on Aave, and I remember I was in France for another conference, and I remember my health factor going to 1.01, 1.00, 0.98, and at this point I was supposed to get liquidated on Aave. But thanks to Ethereum and its high fees, I wasn't liquidated, and I actually kept all my collateral. So I kind of know what it feels like, and I went throughout this whole thing by myself. And I guess we have two sexes on the stage with us. And I would just like to know, what do you guys think about this event? Were there any ADL liquidations? And maybe you can also give the definition of what ADL is. I think it could be pretty interesting for people that are listening to this because it's a pretty interesting mechanism. And then also understand the behavior of retail traders. How did they react? Were they actively trading during this time? Were there any downtime on your exchanges? What exactly happened?
So if I can go first, thank you. When I heard that panel topic was 1010, I had to look up what happened because I didn't recall what happened in my exchange. In Upbet, we only have like plain vanilla spot trading. We don't have any perp. We don't have any like leverage facility. So nothing much happened in my exchange. BTC dropped like 10% plus, but there is another day in crypto. So we thought like, it's okay. But we heard people like screaming online, and we were shocked what's happening out there. And we realized that there's like massive liquidation in highly leveraged marketplace, especially when the collateral was backed by like some USDE, which provided like 12% yield. A lot of people like use that as a collateral, like, and it was deep. There was deep pegging, like 50% deep pegging. So there was a lot of retail users who got liquidated, like unfairly in my view. And I think that incident reflects how bad or ugly it could be if crypto is highly leveraged, based on like very flimsy underlying asset as a collateral. And that is like against the idea of initial BTC, which was kind of reaction to highly leveraged financial product. So I think it gives us a certain idea to reflect upon.
Well, here I want to jump in because interestingly, we share more or less the same experience, but have a different viewpoint on that. So we're BitMEX, we're a derivatives exchange only, inventor of the perpetual swap, never lost a coin. If you look at 1010, we have been the derivatives exchange that had the least liquidations and the least ADL compared to open interest as well as on absolute level. So actually it was just not like any other day, but we're like, oh, we have a lot of volatility in the market, but hey, everything works as intended. So my take on that one is slightly different, sorry. It is not about leveraged positions. Leveraged positions are actually not levered. It's just a matter of payout profile. It has nothing to do with lending. That's often misunderstood in the crypto world if you come from TradFi. But what it is about is how you arrive your methodology for liquidations, how you derive your methodology of ADLs. I agree with you on collateral currencies. So we only accept high quality, high liquid collateral on the platform, not every other coin. So we have like 5 or 6 coins that we accept, and they're all highly liquid and have low haircuts. That helped a lot in this because you don't have self-enforcing feedback loops. And the main thing about the leveraged positions and the perpetual swaps and dated futures is actually how your mark price is derived. So what does it mean? So I have let's say, a perpetual swap position, whatever, doesn't matter, like 50,000 long on BTC, and now BTC falls below 50,000. So that calculates how much collateral you need to place. If you don't have enough collateral, you're liquidated to protect the winning side of the trade. That's often misunderstood. If you are liquidated, it means someone else is protected. Because if you cannot pay your collateral, the winning side of the trade, if you are a real peer-to-peer exchange, would suffer the loss, right? So the question is, how do you derive that mark price? And some exchanges reference to their own spot exchange. We don't run really a spot book, so actually we don't reference to our own spot exchange. Number 2 is for every underlying asset, we try, you cannot do with all the altcoins, but for the major coins that are liquid, we try to come up with an index based on a price feed from various exchanges. So at least 3 up to 5, which basically means in a situation like 1010, even if one exchange stops trading, which means you have no mark price feed and you're going to liquidation immediately, or something weird is going on in your books, we still can calculate the mark price. Number 2, if something happens on one exchange because they have operational problems but not on others, we actually even that out. So we smooth that, right? So you have a fairer market price, right? Because the market price on any exchange is not the market price. The whole market consists of, I think, more than 300 exchanges these days. So, and with that one, we rode the wave pretty smoothly. What I have to say is that I don't know whether that is in line with yours. In the whole market, this time institutional players and market makers were hit way harder than retail investors because they had the positions and they couldn't get out of it fast enough.
I think this was kind of the consensus when the 1010 happened. It's that we will see some bodies float once everything smoothes out. We have seen some companies closing, but we haven't seen any major news of what could be compared to FTX exploding, for example. So I think, and it's one of the things where I actually agree here, it's that we tend to say that the retail were the most impacted people, but the fact is that the open interest never recovered says a lot about, because most of the open interest isn't retail people. So it means that because of this event, a lot of these institutions and market makers actually take less risk or decide to limit their exposure to the crypto market. So I think there is some truth there. And I just wanted to go back to you, Alex, as well, because you told about the Ethena USDE depegging. So what actually happened, it only depegged on Binance, on chain. So for example, on Aave, the risk parameters set by the risk council were actually pegging USD to 1 USDT. And throughout 1010, I think Ethena processed 3.5 billion in redemption without any problem. So it was a purely Binance Oracle problem. Just wanted to clarify that.
Yes. Well, I won't say there is that specific asset problem, but when certain asset is used as a collateral in that confined environment, it can be a systemic risk in that environment. So in that sense, I agree with you that we have to use a quality asset as a collateral so that we can avoid certain unfortunate situations. But given that a lot of retail users got liquidated, I think it was a very, such an event should be prevented.
Arden, can I say something and I'll shut up because I'm the only traditional finance guy in this awkward, very well curated session. So heading Hamilton Lane, digital assets, we're 1 trillion AUM, AUA, private markets only manager listed in NASDAQ. And the October 10th event was to our benefit, a major one for RWA. So allow me to just tell you 3 things that we have defined as the 3 R's, like alphabet R. But before starting that, a little bit of ice breaking because I saw some people leaving because it's so technical and so cool. Coming from RWA and being a Korean, I'm Korean, and it's great to be a Korean with BTS and K-pop, but being in crypto and DeFi and blockchain, I must say it's the worst time to be alive as a Korean because of Lazarus. They don't care if you're a Southerner or a Northerner. So on behalf of this industry, I apologize. So it's really bad because you get hammered by it because that's also what caused the post-1010. 3 trends that happened afterwards. First, let's start with regression and re-centralization. So 1010, the open interest, Artem, didn't get recovered because maybe they came to tokenize RWAs, right? Could be. But regression and re-centralization exponentially fueled by drift, kelp, that really killed everything I was doing on the RWA side. But now all of a sudden, you have chains that are focusing on privacy, KYC, AML, security, winning the war. So now you have zillions of announcements of institutions building on the likes of, Kanta. I'm not saying which one is better or not. I mean, we don't know. We just go where the money is. But, one last example. Last week, we announced with Allfunds and BBVA, the 3rd largest Spanish bank, we issued on Hyperledger. That's what Allfund uses. And they were very, very happy. It was no drama. It was secure. It was predictable. There's no hacks. It's very good. Which leads to my second R, which is the resurgence of TradFi coming into DeFi. Now, all of a sudden, you have NYSE investing a few $100 million into OKX. You have NASDAQ with Kraken. You have LSEG. You have, on top of Börse Stuttgart and whatnot, all going on chain. Is that it? No, you have also banks, Morgan Stanley, now self-custodial solutions, E-Trade, they announced it all, right? You have HSBC, Standard Chartered, issuing stable coins in Hong Kong. You have regulators in Hong Kong announcing, secondary trading through circulars on the exchanges and allowing stablecoin issuances in Hong Kong. And, Guardian and ADGM, you have everybody now, TradFi, going into DeFi. And also the ecosystem, fund admin, transfer agents, fund platforms, iCapital, Calastone, everybody has announced blockchain, right? So everybody is going, TradFi going to DeFi. I think that's a resurgence. And last but not least would be, and this is the most important, real world assets, right? Real free cash flow real yield from real world asset because they're not correlated with crypto. And I think vaults are a living proof. But let me tell you the growth of RWA, tokenized stocks, prediction markets, since inception, which is from 2020, 2021. And let's guess how much of the growth was achieved post 1010. So RWA, so give or take 25 to 30 billion. 40% of the growth has been achieved in the last 6 to 8 months, right? Now that looks cool. Let's go one level down, tokenized stocks. Artem, what's your, it's 1.5 billion. How much do you think the growth was post 1010?
Well,
percentage?
Because I know X stocks has been heavily pushed by Kraken, I would say, I don't know, 250?
So 80% of the entire growth since inception has been achieved over post 1010.
Okay.
Let's go to prediction markets, 90%. On a transaction volume per month, used to be 1 million, right now it's 20 billion per month. So again, 90% achieved post 1010 if you call prediction markets real world assets, right? Yeah, I mean, that is crazy. So at the end of the day, people realize that, hey, vaults would be what ETFs did to capital markets, compliant vaults with good KYC AML and good designs. We're already at more than 300 billion deposited. So that's also a close to a 60% increase post 1010. So my take, as Stefan was alluding to, is finally maybe it's time for RWA to go into the blockchain rails and take advantage of what DeFi has to offer. I mean, this was repeated through Jenny Johnson today. So I mean, there's a lot of things that are happening mirroring RWA on top of the crypto technology. So I just wanted to say that.
Yeah, and I just want to add to that because, I mean, it's easy to now talk about what went wrong on 1010. But I think, we should also talk about what went right, because the reason the crypto industry is still here and the reason there are still people here is because the whole concept of automated deleveraging worked. It actually was designed to do exactly what it did. And I think this is exactly why some of the more traditional institutions decided, you know what, there's something interesting here. Because ultimately, look, this would have been a complete 2008 kind of disaster if there wasn't this automated deleveraging infrastructure all in place, that these incidences are happening, how are we going to unwind everything? The fact that it all unwound smoothly, yes, there was a lot of people impacted. However, there wasn't a catastrophe that it destroyed the entire industry. And that I think we should really actually be talking about.
I like that you get to this point, because that's what in private basically I stress as well. If you look at the two biggest events of the last years, which was FTX and this one, I mean, if you look at the sheer size, and I'm not going to notionals, right? If you look at notional liquidations, it doesn't mean anything. It's just numbers. You need to look at the collateral that was burned, because that's the real exposure. But if you look at this, and this would have happened in one financial institution, regardless of where in the globe, we would have another great financial crisis, because they couldn't figure out fast enough who's owning what and where you actually allocate the losses to, right? And both actually, I mean, both bad examples. I would have loved not to have them rather, but they show that the technology is fit for purpose and that well-run centralized exchanges are fit for purpose as well. So it's not about the goals of regulation, it's just about how do you achieve it. And we have shown in the crypto and digital assets industry that you can achieve the same level of comfort and stability with a different technology and different mindsets, right? That I just wanted to echo, right? Because it's completely what I say. But I wanted to get to you as well. We see the same at BitMEX. After 1010, well, the interest in it just grew for, well, we call it now RWA. I just call them digitized financial assets, because we're not there yet to tokenize real estate or stuff. But it was really like the demand, and we see that on BitMEX as well. So we have equity perps now, we have FX perps, commodity perps. We go actually into more TradFi kind of world. We want to roll out, like in the next month, so-called spreads. I mean, this is just a word. It basically means we want to make the term, so yield curve, you would say, in rates, the term being tradable for institutions as well. And we see a lot of interest of mirroring what you have in the TradFi world now in the crypto world, which, I mean, again, it's more like for us, not speaking about others, we love that very much because it's at the core what we do because we are very specialized and we can do it.
Yeah, and so just to...
Yeah, sure. Go for it.
Because, and I think this is what excites me is that out of the disaster, and look, the 1010 was a catastrophe for a lot of people. However, what's coming out of it is a real advantage for the industry. And as Victor highlighted, the growth in RWAs is not just that everybody thought, okay, I've got this liquidity now, where am I going to put it? It's not just about that. It's about exactly about the innovation now that people are saying, if I'm going to take these RWAs now on this infrastructure, what can we actually use this for? What is the utility of this stock or this fund, etc.? Because otherwise I could just hold it in the traditional way. The real advantage of tokenized equities or funds is what can I do on chain and take advantage of this really resilient infrastructure? Because this is what the exciting thing of 1010 is that the money's going into RWAs, but now with exciting exchanges that have shown that they are a lot more resilient than TradFi. What can you now do with RWAs? And this is what excites me and my organization to work with firms like Hamilton Lane and others, is what can we do to bring traditional finance into the more decentralized finance?
Perfect. This is the perfect transition because I wanted to push back on what Victor said and you actually gave me another way for doing so. So, I'm going to do my job as a moderator here and I'm going to push back a little bit on what you guys have been saying. I agree with the fact that on 1010, after 1010, what we have seen is the resurgence in new assets and new products going into crypto. So we are seeing institutional players deploying their own products on chain, which is essentially a way for them to generate additional profit and distribute it to a new audience that they wouldn't be able to reach before. However, institutions, when we were talking about this, and I remember the first edition of Proof of Talk, we were already talking about, well, the next bull run will be institutional. What we were thinking is that institutions are going to come on chain and buy our bags. Essentially what crypto industry has built over the last 8-10 years in DeFi, in protocols, in governance, take part in decision-making process. However, this is not what we are seeing. What we are seeing, even since 1010, we have seen a number of institutions try and come on-chain, but to distribute their own products. So my question would be here is, and I think it's one of the most important ones, and I think it's quite interesting to answer to this one, is why are institutions interested in buying tokens and holding them? And do you think it will change in the coming years?
So first, there's always three angles, right? I mean, you have to see operational efficiencies, right? Less people, less money, and more profit, right? Sounds like AI, right? But it's not AI, it's blockchain. We can do that. So for example, I'm a bank, I'm giving you a loan. Now, I don't need to, Artem, look at you as a person. I look at your underlying assets as a collateral. And atomically, I can give you a loan. Now, instead of me taking 2 hours to issue a loan with papers, now I can do it in 10 seconds with smart contracts. So again, crypto world loves TPS. This is loans per second. Now you can loan even more. What about balance sheet? I don't need to use my capital. Say if Aave and Morpho works well, hey, that's I can still charge an underwriting fee and make more profits, right? I mean, it's all incentive driven. For us, it's been more about access. It has to be two of the three: cheaper, better, or faster. Like private markets for us is still an email that takes 3 days to arrive. You need to do paperwork, right? And you cannot invest with $500. You have to have like 1 million or 500K. Fractionalization here makes it available. You can do with wallets, zero hash, crypto payments. That allows us a new universe of AUM. So at the end of the day, it's either are you looking for $1 earned or $1 saved, right? Dollar saved is on the operational side, and we're a fund on chain. And after, you were my first client, right? I mean, you've tokenized one of our funds 2 years ago. You had a survey, you had some stats, 40 basis points cheaper by making it, even it was a feeder on chain. It was 40 basis points cheaper. That's a lot of money. So, you know, we want to go because you can save money on the dollar save, which is not taxed, and you can earn new dollars through on-chain realms.
Yeah. Sorry, go first. Yeah. No, I was just going to say, like, you know, that's absolutely correct because ultimately, it's not just about tokenizing something and getting it on chain. You know, the question to really ask is, why should I do this? Is it going to be cheaper for my clients to access? Is it going to be easier for them to hold it and use the assets for something? So it all comes down to cost or utility. Those are the two things. Well, you know, because, and this is what we're starting to see now, that can you get top quality funds like Hamilton Lane's onto the chain and have it in people's hands at a fraction of the cost that it would be to hold them off chain? Or can I use those assets in a way that I cannot easily utilize them in the traditional world? For example, for me to use them as collateral on a collateralized loan in a traditional world is very, very hard. But on-chain, the infrastructure is designed to actually do that. Or can I actually use perps or anything like that? This is what's been developed over the last 5-6 years on-chain, this kind of infrastructure. So the bringing of RWAs is a natural progression. And I believe in the next 5 years, the transactions on-chain is going to far surpass anything that's happening today. And the majority of that new flow is going to be coming from RWAs. And I've been in the industry for over 10 years, tokenizing assets, and I believe that now is a time where the infrastructure is there to really kick this off.
The banker, and I'm like halfway banker, that's my background, I'm an old guy as you can see. The banker in me totally agrees with you, and I'm like, yes, yes, yes. I check all the boxes. The crypto guy in me has a slightly different, not viewpoint, I still agree with it, but I believe there is more to it. What we start, or what we usually don't look at is, you mentioned that, but it's access and distribution, right? After the volatility went down, so let's forget about 1010, that was a massive volatility event, but after 1010, the volatility of crypto assets is lower than the one of stocks, right? These days, if you want to have a degen trade, you trade US equities. Sorry. I mean, that's just the fact. If you look at
you listen to Donald Trump, whatever company he shields during his speech.
Whatever, not going into this, just stating the obvious. So that means a huge crowd of guys, the crypto natives, that don't want to open up another brokerage account with their usual bank, wanted to have access to those assets. So, and then some TradFi players said, you know what, we have lower costs, so we do it. If they would have had higher costs, they wouldn't have done it. But we have lower costs, so yes, we get into this. And then it's about distribution to people they cannot access otherwise, both ways. The crypto guys couldn't access the assets, and the actual TradFi guys couldn't access those people, right, as a distribution layer. And this was now bridged, right? So you could say 1010 was the biggest, well, what is it, windfall profit for TradFi, basically, to get their products to the crypto world. And not meaning that in a bad way, I'm not judging. It's just like, if you look at this, this is what it did.
I kind of agree with Victor that now the industry adoption of crypto is mostly driven by efficiency or revenue generation potential. And I think it's nice and it's healthy, it's more sustainable. It's better than like working on the pixelated Lego man, at least. And we can make the Ferrari with Lego, but what's the point in that? It should work. We have to make a balance sheet out of the business of tokenization, perhaps. In that sense, I see tokenization with most liquid asset class, to be honest. And if we talk about RWA, the most popular RWA should be USDT, because it's based on
tokenized dollar.
USD,
yes.
tokenized gold. And from there, we are like looking at like MMF being tokenized. So we see tokenization of real-world assets from most liquid one to lesser liquid one by one. And if you are degen like speculative trader, you might be like trading in stocks or even index, not BTC. So also 1010, they kind of like it gives some impression on investors in trading in crypto like leverage product. So there are some level of like deflation of the interest, which is healthy and necessary. Imagine that event happened in trade finance. how many companies will go underwater. But it didn't happen in this space. So it somehow, in another way, proved the resiliency of the sector, which is driving this industry toward a more matured direction.
And so since 1010, and I think it's kind of, we are getting to the end of the panel right here, we have seen that in traditional markets, we have seen new all-time highs in almost all assets. In the indexes, in the individual stocks, in overall performance, especially in the US. At the same time, Bitcoin since 1010 has declined. So even after the huge liquidation, we are at 69K today. And we are seeing that today crypto, especially the altcoin market, is only going down. Essentially today we have two assets. You have BTC and Hyperliquid. These are the two assets. One of those is going up, the other one is stalling. And so my question is, before we used to see a huge correlation between Nasdaq and the S&P and the Bitcoin. Today we're seeing the same correlation, but only when it goes down. When Nasdaq goes up, Bitcoin stalls or goes down a little bit less than Nasdaq. And before, crypto used to be this sector where people would come for volatility or for opportunity. And today what we are seeing, and as you said it before, as you pointed it out, we have more volatility in stocks, in indices. So it's really hard to make a case for crypto today. So what do you think would it take to make crypto the sexy asset again? And what is your possible explanation of what is happening?
Okay, I'll just start being from BitMEX. I think here is, and sorry for that, a little bit to uncover, or let's say to delineate. For me, it's like first starting with Bitcoin. 1 year ago, most of the people thought the Bitcoin cycle is over, this 4-year cycle. Actually, if you look at the numbers, we're pretty much behaving according to plan, right? Which would call, and this is when, let's say, it's not a prediction, but like a projection. If the Bitcoin cycle is still valid, we will see something like towards the end of the year, like Q4 recovering. And what is important, maybe for some of you here who are not here from the beginning, it has two angles, supply and demand. Demand is actually, I totally agree with you, is a little bit in dire straits and looking at strategy as well. They start selling, which they said they didn't. So there are a lot of signals that destroy trust, right? At the same time, the supply side is made up by miners, right? And they are in a complete shake-up phase right now. So they will re-evaluate who is going and will be in business and so on and so on. So and this will be then, I mean, give or take, right? It's not a prediction, it's not a law, but if you look at it, we will see something coming. So I'm rather optimistic for Bitcoin, and I believe more in the technical underlying 4-year cycle. Then you have the main coins who have suffered dramatically, even way more than Bitcoin if you look at it, which is due to the fact that after 1010 and even before, the question really is, what are you here for? And it's not a criticism, it's just like you have so many layer ones, right? That you don't know what they're here for, and they all need to find their own commercial thing, so to say. Ethereum, somewhat clear. It's more like, what do they do? What's coming up next? Do they really capture value? Solana is more for the retail side of things, and here is another one on the altcoins. I said this, I think, on other panels as well. I like altcoins, but they are not financial assets. They don't behave like financial assets. They are consumer products. Right? This is why they shouldn't be even regulated as financial assets, because they behave in a different way. It's not some cash flow streams, it's a purely social asset, or mostly social asset. Right? And this is why they behave differently and they are way more volatile. But I think like Bitcoin, then you have like the serious layer ones, they need to find their way where they are and what they actually want to serve going forward and what their commercial case is. And then you have altcoins where you now need to go one by one. Right, this is why I believe we see this, and with RWAs from TradFi, so we call them TradFi perps on our exchange, it's basically you get what you see, everyone's used to it. So you have that flight to, well, I don't know whether it's quality, but let's call it flight to quality for a moment, right? As long as they all need to figure out what's going next. So that's my personal view.
Yeah, I mean, I just want to agree with a few points and challenge a couple of other points. I absolutely agree with the Bitcoin side. I think that is ultimately like almost a commodity. You know, it's hard to quantify what is the true value of Bitcoin, and that you know is all about supply and demand. Now, pretty much the majority of the other coins, I recommend everybody to read a paper that we published last year, funnily enough, just before 1010. And it was actually talking about the statistical correlations about value generated for altcoins, even Ethereum. Where does the value come from? The market cap, etc. And you can actually quantify very, very clearly the increase in the market cap with various other factors. And one of the key factors that shows the increase in the market cap is actually the fees generated on the underlying and where the fees actually come from. Do they come from just the network security, or do they actually come from fee generation from some kind of product market fit? And that statistical analysis was published last year, and we put that on CoinDesk as well. And everybody should have a look at that because it's very clear that alternatives are going to become a product in themselves. And that product is going to be driven, the value is going to be driven by fee generation and how those fees are generated. And that means we're going to see a delineation of the kind of assets in crypto. The pure commodities, all about supply and demand, like Bitcoin, etc. And the other ones that have a tangible value and how that value generates fees, etc. for the ecosystem. And this is what we're going to see. And we're going to start seeing a lot more of that in the next 5 years. And this is where I believe RWAs come in, because RWAs is not just going to be about, I'm going to hold these assets on the blockchain. It's going to be about what other value can we generate on this infrastructure. And that's going to generate additional fees. And hence, we're going to see a premium of traditional assets on-chain than off-chain.
I might just add Hyperliquid here, just for to be fair here.
Our analysis.
I want to add one point on top of that to separate the asset and underlying system. So I see Bitcoin as a peer-to-peer electronic cash system rather than an asset class in a way. So Bitcoin is entirely a payment system in my view. And there is a value of like new ledger system. There is a value in immutability, and that value sometimes is disconnected with the price of Bitcoin. Even though 1010 Bitcoin price dropped like by 10%, it does not mean the value of that new ledger system dropped by 10%. Like as he mentioned, like price of Bitcoin depending on supply and demand. That's it. It does not have any impact on the underlying value of the ledger system. In such a way, even though like there is ups and downs in the market, experiment, institute adoption on digital asset, it will keep going like in steady manner.
Well, we have 1 minute left, so I have one last question for you guys, and I'm just going to say to need an answer from you, yes or no, and the second one, what needs to change? The first, so the question is crypto ecosystem mature enough? Up to you.
Yes, it's maturing.
Maturing or
sufficiently
mature?
mature to do new things now. Post 1010, I think that's also the point of this.
Yes.
No, it's not mature enough, and nothing is mature enough, even the whole finance sector.
Well, it's an easy answer.
I say, like to your point, yes and no at the same time. Depends on what you look at.
So not taking any risks here either. Not taking any risks here.
No, I think there is no ultimate truth. If you push me, I would say rather yes than no.
Okay. Okay.
I mean, I'm going to be the contrarian and answer in a slightly different way and say, it's not about the maturity, it's about the perception of what you are thinking is mature or not. It's not the infrastructure, it's the risk management side. And I think this is where I think crypto showed itself in 1010. The risk management technology is way above and beyond anything that's out there in traditional finance, and I've spent 15 years in that industry, and I can say that affirmatively.
Well, it's a good note to end this conversation on. I have a blinking timer that says we are over time, so please give it up for the speakers.
Thank you.